Hey, Michael, actually, you guys do national, right? Not just
Yeah,
states?
we do. Yeah, correct. We do. Just not the Northern Territory.
In terms of your offices, Eastern states only?
So our head office is here in Sydney, but then we have buyers agents and property managers on the ground in each of the states and territories that we're purchasing in.
I see. So like if they wanted Perth, Adelaide, Darwin, well, no one buys Darwin.
Well, yeah, just not the Northern Territory. Yeah.
Okay, yeah, interesting.
Yeah.
Good. So obviously the interest rate increases have been affecting house prices. Is that the main driver of sustaining house prices, do you think? I guess you'll cover all these in your slides later.
Yeah, I don't want to give away too much, but yeah, it's one of the key drivers. Obviously, it's been no coincidence that when the interest rates started rising in May, last year, that we started to see that market cool, but it was already coming off a fairly significant high as well. So
we actually, guys, there's 14 people that are in the that are on, so we might be able to get started.
Saw that. All right. Fantastic. So welcome everybody who's joining us today. We're really excited to be having this conversation for anybody who's interested in buying in Australia. I'd like to introduce myself first of all. My name is Sabrina Holmes. I'm with the Australian Business Council. Super excited to invite our speaker, to introduce our speakers today. I've got Ben Wong from Odin Mortgage. Hi, Ben. Ben is a co-founder of Odin Mortgage, and he'll be chatting to you today, and they'll be sharing some slides and some information. And we've got the two co-founders of Milk Chocolate, based in Australia. I've got Michael Cleary and Richie Regal.
Hi everyone. G'day.
The guys are going to be sharing some slides. There is a Q&A button at the bottom of your screen. If you've got any questions along the way, please feel free to pop them in there, and we'll open up to some questions towards the end. But please feel free to pitch in at any point, and we'll make sure we get to those towards the end. I'm going to hand over to Ben to kick us off.
All right, cheers. Thanks, Sabrina. So welcome everyone to the 2023 Buying Property in Australia webinar, where we'll be sharing some market insight, tips and tactics for Aussie expats living abroad. So as Sabrina has mentioned, any questions you guys may have, don't hesitate to ask in the chat box, and we'll get to them at the end. So the first thing I would like to cover is the current general Australian lending overview for those of you who are residing overseas. What's available and what's been happening in 2023. So in terms of what is still possible from a lending perspective, if you're living overseas, you can still borrow up to 80% of the property purchase price. Some banks only do 60%, some banks only do 70%, but you generally can still go up to 80% and even up to 90% with lender's mortgage insurance. But very few banks do offer this. It's just one bank, in particular, Commonwealth Bank. You can still do equity cash out. So you can top up your loan. If you have an existing loan that you paid down or your property has increased in value, we can top that loan back up to 80%. Or, if you have a property that doesn't have a mortgage on it, unencumbered, we could use that property as additional security to help you borrow more. And in Australia, we can do 30-year loan term. Doesn't matter how old you are, so long as you can provide positive cash flow, that you're still employed and working. Even if you're 70 years old, they'll still give you a 30-year loan term, which is great because other countries like Singapore, Hong Kong, they do look at your retirement age to determine your maximum loan term. And that does inflate monthly repayments for the older folks. There's no early repayment penalties in Australia by law. So you could take a mortgage out today and then pay it out tomorrow. And they won't be charging you with that 1-2% early repayment penalty like they do in other countries. So that's all the general points. Pretty flexible in terms of lending and what we can do from Australia. But in terms of what's been happening in 2023, it's mainly a discussion about interest rates, to be honest. As you can see, month on month, rates has been increasing, and it's all over the media. So as rates increase, so does the assessment rate that the bank assessors use to calculate your repayments. So even if you are on an interest rate of 5%, for example, they don't use 5% to assess your debt. They use 8.6% because they put up a buffer of 3% on your actual interest rate. So at the moment, it's now 8.6%, which is what they use, and that does affect your borrowing capacity somewhat. As I alluded to, increasing interest rates, but in the last 2 years, fixed rates are no longer as attractive as variable rates. So in 2020, 2021, fixed interest rates were lower than variable rates. That has now flipped the other way around. Variable rates are now the cheaper alternative, and what we're seeing most of our clients opt for. I'll be sharing some charts and graphs later on, and you can see better. Fixed rate cliff. So this is a hot topic of recent months, and what this means is a vast majority of people are currently on fixed rate mortgages, and those a majority of which are going to expire this year. So when they fix the interest rates, you could even fix your rates at one time below 2%. So to go from 2% to 6% now, that's a huge increment in monthly repayments. And what a lot of people may be shocked to find later once their fixed rates end. The majority of our clients were fixed. And when we originated loans for back in 2020, 2021, I'll share some graphs on that as well. And there's fewer lending options. So these two logos here are Kudos Bank and Heritage Bank. So back in last year, 2022, we had these two options available for expats living overseas. Kudos Bank particularly was one of our favorite banks for people living in the Middle East. They allowed us to use 100% of the dirham or whatever income you're earning in the Middle East, and they wouldn't apply any income tax. Well, there's no income tax in the Middle East anyway, but a lot of lenders still force us to use Australian income tax rates. So these banks didn't, and also allowed us to use 100% of your foreign income. So in terms of borrowing capacity, it was very strong. We sent through a ton of deals their way, and they're not a large bank. They're probably top 20, top 25. And because they weren't a massive bank, the amount of deals that we sent through their way, not just us, other people as well, I'm sure, it did skew their loan book to the point where 10-20% of the entire loan book was foreign income applications. And the regulators just did not like that. Just said that it's too much risk, I suppose, if there's any changes economically that would affect people living overseas that were Australians. So they pulled out of the lending altogether. So they no longer lend to people living overseas. And the other bank, Heritage Bank, again, same thing. They're not a massive bank, but they're still pretty big, the largest mutual bank. Same thing happened. So they just reduced from 80% loan to value ratio to 70%. So that said, we still have a lot of great lending options available for people living overseas. This slide here is about housing interest rates up into January 2023. Here it shows the interest rates of the past few years of what the average interest rates for investors are. So as I was alluding to, the red line there is the variable rate, and the other two lines are fixed rates. So as I was saying before, fixed rates were lower than variable, in 2021 and 2022. So the vast majority of our clients, and I'm pretty sure a lot of other people, fixed the interest rates at this point because you're getting fixed rates around 2%. A lot of people did it for 2 to 3 years, unfortunately. Like thinking back, everyone would love to do it for 4 or 5 years now. But they fixed for 2 to 3 years. So in 2023, which is now, those rates that fixed in 2021 is going to end soon. And that's what the fixed rate cliff is about. It's in the next graph. This chart is only up to January 2023. So in February and March, there was an increment in the cash rate by 0.25% each month. So you can actually add 0.5% onto these rates. So I would say the average homeowner right now is on around 5.8% for variable if they're investor, and fixed rates are now in the 6% if you were to fix your interest rates at this time. It's highly correlated to the RBA rate movement. So whenever the Central Bank of Australia increases rates by 0.25%, variable rates also go up by 0.25%. At the moment, though, we can get investment fixed rates from 5.89% and investment variable rates from 5.5%. So if you're someone right now with a mortgage at 6% or higher, definitely come speak to us. We'll be able to refinance you to a much lower rate product, or at least help negotiate. And a lot of lenders right now are offering cashback incentives, as in they will offer anywhere between $2,000 to $4,000 to refinance your loan across. So you are ahead on day one, essentially, because the fees for refinancing is only around $500. So, with the $4,000, $3,000, you'll be up ahead 2-3K. This next slide here is the fixed rate cliff I was mentioning. So in terms of this graph, just look at the dates at below. It shows you the dates that the clients have fixed their interest rates. Okay, so I think what is most relevant now is we're in March, right? So we're March 2023 now. So we should look at this one here. March 2021 is when, this is for 2-year fixed rates. So we could see that on average, people fixed their interest rates at 2.09% 2.02% in March 2021. So by the end of March 2023, so that's 2 years from now, the variable rates they're expecting now is around 5.5%. So that's an increment of around 2 to 3%. Okay. From what the Reserve Bank of Australia is saying, around 35% of fixed rate loans will expire this year in 2023, with April 2023 probably looking like the month that's going to hurt the most. And so in April 2021, fixed rates 1.98%. Yep. Once they expire, can expect 5.5%. So that's 3.5% increment. It equates to something like this. I did a calculation based off on a $1 million loan amount. Actually, I can't recall, but the repayments would be from $2,000 per month to $3,000 per month. On average, it's around a 40% increment, but in this case scenario I was using is around a 50% increment in repayments. So people who haven't fixed, they're already on variable rates. They've already been paying this much higher repayment for a while now. But people who have not, who are on fixed rates coming off, they may need to look at readjusting their budget, because it's a big increment. Some of our clients have much bigger loan sizes, especially as Aussie expats or people living offshore. The income relative to Australia is much higher. Usually you guys are in the top 5%, top 1% of income earners relative to Australians living in Australia. So loan sizes are generally quite large, 2 to 3 times bigger in our case. So interest rates post-expiry likely much higher. So what I meant by this was these rates here, when I said that you come off to be 5.5%, not really the case. So usually once your rate expires, the bank that you're with will just give you the standard variable rate with their default discount. So most of our clients, if they're not getting the home loans reviewed, they'll probably be on 7 to 8%. It's actually really high. So just message here is just be aware of your fixed rates that are ending. Most of you should already know, and have that looked at. This next slide here is the RBA cash rate target. It's showing the cash rate set by the Central Bank of Australia. As you can see, it went down. It's been trending downwards for a while, and we were at all-time lows of 0.1% cash rate for a couple of years, which was a really good time for us, actually. All rates were all-time low. Everyone was getting a mortgage. I think if you just look at some other slides, I'm not sharing today, but the amount of loan approvals, it's probably 2 times more in last year relative to this year. But since then, the last several months we've seen back-to-back rate increases, 0.5% to 0.25%. The last 2 months was 0.25% increments. But based on the consumer price index indicator, suggesting now that the inflation has peaked in Australia. Not saying it has, but that's what's been suggested and alluded to by the Reserve Bank of Australia, which is good, because at this point now, we should see inflation start to slowly trend downwards, which is, and in doing so, interest rates should start plateauing and maybe even getting our first rate cut early next year. Okay, so because with interest rates, it's all about controlling inflation rate, mostly 80%. It's about just controlling the inflation rate. And the RBA has advised that inflation probably likely to decline this and next year to around 3% by mid-2023, which is in line with their target of 2 to 3%. Possible rate cuts coming over the next couple of months, but it's no longer a certainty. So if you look at the governor when he speaks about cash rate increments, previously he was very, I would say, confident that rates were going to keep increasing, but it's sort of changed its tune now to be something like more, they may increase, they'll look at it, but it's no longer a certainty. So hopefully we have plateaued in terms of rates and looking at downtrend maybe early next year. Moving past rates now, I'd like to advise you guys what the banks are actually looking at when they're thinking about lending you money. It's mainly two main factors that they're looking at. One is your deposit, and then the other is your income after expenses, which is just your disposable net income. So in terms of deposit, it's quite straightforward. It's just how much money you have in a bank, liquid assets such as shares, even cash gift from your parents or relatives, and or equity from existing properties. And I'll cover that in the next slide. But here's an example. If you're buying a property for $1 million, as I say, you could borrow up to 80%, that's 800,000. And then you factor in stamp duty and other fees. Here, I just use 5% of the purchase price. Here, then, so you will need to come up with $250,000. So the bank just wants to see that you have $250,000 in liquid assets. And if you can prove that, then that satisfies the deposit requirement. So in terms of the equity cash out that I was alluding to in a previous slide, here's an example of what I meant by that. Let's say you bought a property in 2016. So for those of you who have property, and you have property 5 years ago and it's increased in value 5% year on year. Let's say you do a valuation on this property this year. It has gone up from $600,000 when you bought it to now $800,000. Previously, you did a mortgage of 80%, and then maybe you pay down your mortgage by $80,000. So now the loan to value ratio is 50%. So we can take cash out or release equity from this property by bringing the loan to value ratio back up to 80%. By doing so, we can cash out $240,000. So $640,000 total loan now divided by $800,000 is 80%. Going back to that previous example, where we're looking to buy a $1 million property. Previously, I said that you need $250,000, right? So here you can actually get cash out of $240,000 from your existing property. So you would only need to come up with $10,000 of your own cash. So for people who don't have too much cash, but they have existing properties, then this is actually a very standard and typical investment in property investor strategy. It can do you wonders in a bull market. When property prices are going up year on year, you buy a property, it goes up in value, you keep taking cash out, and then that helps fund your next purchase, and on it goes. So it's great when property prices are trending upwards. Not so great when property prices start to trend downwards. So therefore, highly suggest people work with the buyer's agents who can increase your probability of finding a property that's actually going to appreciate in value. So that strategy works. So the second main thing that the banks look at is income. This is the biggest thing from our experience in terms of whether a loan can get approved or not. Because as I was saying, proving deposit, that's very easy to prove, but income is a bit different. So in Australia, there's over 30 different banks, a lot of banks, but vast majority of banks will not lend to people living overseas. And the ones that do, we can categorize them in standard banks and expat-friendly banks. So I'll go through the differences between these two in a very simplistic format. So with the standard bank, they will discount foreign income straight off the bat by 20%. So if you're earning a dirham, 50,000 dirham, we're only going to be able to look at 40,000 now. Okay, they discount by 20% to account for foreign currency fluctuations against the Australian dollar pair. And then after that, they apply Australian income tax rates. So in Middle East, zero income tax, but they still apply Australian income tax rates. Why they do this is because the banks don't have the resources to try to understand every different country's income tax rates. So they just apply Australian income tax rates. It's already the harshest, well, not the harshest, it's one of the harshest, right? So they know that if you pass through Australian income tax rates, they'll be fine with it. So hence, someone earning this is usually around, it's like around an effective tax rate of 30%. So we're left with 28,000 dirham. And most people are renting, right? 15,000 per month. We're left with 13,000. And then they apply, the daily living expenses, food, education for kids or whatnot, 9,000. And then we're just left with 4,000 dirham now. 4,000, that's not going to give you too much. You can borrow $250,000 Australian. Now with a expert friendly bank, we have lenders that don't discount at all on the currency. So we can use 100%. So we're still using 50K here. And they allow us to use the local effective income tax rate, which is in case 0%. And then we can just minus the rent, minus the living expenses, 26,000 left. That equates to a borrowing power of 1.2 million. So that's a 5 times difference from a standard bank versus an expert friendly bank. So it really pays to know which bank can give you what. Like I was saying, there's over 30 banks in Australia, and most of them will not lend to people living overseas. And then you go to the ones that do, they may be only lending you 250,000. So that's where we come in as Odin Mortgage. All we do is foreign income applications day in, day out, and we'll be able to tell you exactly which bank can do what, how much you can borrow, how to structure your application depending on the nationalities and type of applicants on that's purchasing the property. And we also have a tax department as well, Odin Tax, and can advise you the tax implications and how to optimally set up your loan structure in that sense as well. So that's actually my last slide. I will end it there and pass it over to Milk Chocolate, who will be discussing property. But thanks.
No worries. Thank you very much, Ben. So we'll just start sharing our screen. Awesome, guys. So again, thanks everyone for joining today. For those who don't know us, my name is Michael. I'm one of the co-founders of Milk Chocolate, and this is my colleague and other co-founder, Richie. And so firstly, guys, just to give you a quick rundown on us. So at Milk Chocolate, we're a complete offering. We encompass research, planning, buying, building, and management. And our property team consists of economists, valuers, qualified property investment advisors, data scientists, real estate agents, builders, project managers, interior architects, interior designers, and property managers, to name a few. So I have to get my breath back after going through that. But in this webinar, we're specifically going to take you through where we see the Australian property market, a couple of case studies on a family home, on an investment property, then just to, again, recap the services we offer and then open up the floor to any questions for us and also for Ben at Odin. But essentially, guys, on that note, we'll get cracking. I suppose the standard disclaimer, any advice is advice of a general nature, and you must consult with the professional services provider before making any decisions. So essentially, I'm going to hand over to Richie now to take you through where we're seeing the Australian property market. You're on mute.
Thanks, guys. Sorry about that. Thanks for joining the webinar. So as Michael's touched on, what I'll take you through today is just looking at essentially where the market is. I think that we get asked a lot at the moment is, when is the bottom of the market going to happen, which is basically the hot topic at the moment. So
one of Richie's favorite questions, so ask it every time you
go for it. But I'll give you all the information today. So I suppose, guys, it's going to be useful for anyone that's looking to purchase a family home or an investment property or start a property portfolio. So there's a number of factors that we recommend that you consider when you're looking at location, to asset type, but also sort of when to purchase as well. So on this particular screen, as I just touched on, it is the question that we're asked every day, day in, day out: when is the bottom of the market? As we don't want to overpay if the market is still declining, which is obviously a fair question. And I fully understand exactly why everyone does ask that, because it is splashed across all of the main mastheads, both here locally in Australia and obviously overseas, where you guys are reading that too. So what we first say is it should focus on time in the market, not timing the market, should be your key focus. So If we look back to when COVID first hit, which is similar times at the moment. So when that hit our shores and the market was on suicide watch, a lot of those investors that took the assertive approach at that point in time, who picked up blue chip assets when everyone else was cautious and wary in blue chip locations without any competition, they are currently sitting on significant amounts of equity at the moment. So the majority of the market sentiment at that time was similar to what we are seeing right now, with buyers holding their position and taking a more cautious approach, trying to time the market. What we always generally say is purchasing A-grade assets with less competition is much more appealing than purchasing the same asset with multiple competing buyers. You'll need to pay a premium to outbid your competition to gain the purpose of timing the market. So once you believe that the market has actually hit the bottom, trust us, the majority of the market will know that too, and will jump in at the same time. And it's the natural human herd mentality with regards to that process. And once people start seeing more positive headlines, it was only just recently that CoreLogic released the latest month-on-month rates, growth rates, and Sydney has now turned a small positive increment in value as opposed to negative decline. Once that starts to pick up, we're going to start to see more people become more active, and that market will start to turn pretty quickly. So right now, when you're looking at this particular chart, the second black circle would be a true indication of where we are currently sitting. So you might say in the papers, they're still reporting capital cities in most capital cities are reporting a state of decline. But it's really, really important to remember, guys, that there is a data lag, and that's between 1 and 3 months in most instances. So the data is taken from the time that a property settles. And in most instances, this is anywhere between 30 and 120 days on average. So what we're seeing on the ground is very different to what's being reported in the numbers at the moment. So when we're actively purchasing quality assets in quality locations, there is competition for good quality stock. And there's no significant discounts available at the moment. So we're also sitting at a circa 14.8% less stock on the market than the 5-year historical average. So meaning the skew of buyer demand is relatively strong at the moment, ensuring the Australian property market remains cyclical. So they're really, really important to understand that. And this graph really does demonstrate the U curve that we're looking at when you're looking at trying to time the bottom of the market. It's actually, when you think it is the bottom of the market, we're already surpassed that. So we are definitely seeing that in some of our key markets. Overall, we put a significant priority on the range of factors when it comes to buying high performance investment properties that goes beyond timing. So when you're firstly focusing on location, asset selection, real estate fundamentals, and owner occupier appeal for resale potential, that should always be the basis of your purchasing decisions, not just the time to get into the market. And essentially, if you're not in it to flip it, then property investing should be considered a long-term strategy. We always recommend that if you're buying property, that you should be looking to at least be holding that asset for at least 10 years time or longer. So therefore, you're negating any sort of cyclical market downswings at that particular point in time, because if you are going to hold it long term in a good quality area, ultimately you're going to see those returns, which is really, really important. Likewise, if you're buying a family home, would you really want to hold off buying a dream home if you found it now and risking it to wait for a few months? The answer is likely going to be no. Your dream home is your dream home. And if it meets all those requirements, it'd be very rare that you'll be able to replicate, given the nature of the owner-occupier home selection requirements. So you're also more than likely going to be living in that home for more than 7 years. So that's really, really important. So the bespoke nature of our service at Milk Chocolate means that we don't apply a one-size-fits-all approach to our investment strategy. So each client's personal circumstances, financial position, and objectives really do dictate every facet of the bespoke game plan. And that basically means, guys, that we do have a finger on the pulse in a lot of the markets across Australia, and they are moving at different cycles. And I'll jump onto the next screen to really just take a bit of an around the grounds of the Australian property market at the moment and what we're seeing and what's being reported at the moment. So what you can see on the key here, so the orange triangle pointing up is indicating a rising market. So there is one sole market at the moment, which is Sydney. The other markets that have got the lines with the triangle facing downwards are markets that are in a rate of decline that is showing a slowing rate of decline. And then you've got a declining market, which we've got Hobart and Darwin. So on that table on the right-hand side, guys, really important to look at that, because where we're indicating on that middle column, that is the average monthly change since the peak of the market. So on average, the Sydney market was declining at negative 1.04%. And what we're showing you here is the February to March monthly change. So actually Sydney reported 0.3% positive growth for that particular period of time. Melbourne negative 0.8 on average, last month negative 0.4, Brisbane negative 1.38, last month negative 0.4, Adelaide 0.33 versus 0.2. This essentially the story that we're trying to point to here is that that rate of decline is very much slowing in comparison to where it was when we started to see these markets cooling in and around Feb, March, April last year. And as I've touched on, the data is, there is a lag on the data. So apply a 30 to 120 day average based on the time it takes for a property to settle, where this data is coming from, which is based on values of homes that have been sold. As I touched on, the market at the moment, we are definitely moving into a market that is very much past the bottom of the market in most instances. And we're starting to see some more buoyant sales in those particular hotspots. So it's a really good graph just to show you guys, because it's very interesting to read what you're seeing in mainstream media. There's obviously an agenda behind some of those mastheads in terms of the picture that they're trying to paint versus what actually is reality and what is actually happening on the ground. And this data is taken from CoreLogic, which is obviously the industry standard in Australia. And also we are mapping this data as well. So really, really important to take you guys through that. And just to quickly highlight, this is some of just the information about the data that we have at Milk Chocolate that we use within our team. And Michael mentioned that we have a team of data scientists, economists, and machine learning engineers. The roles and responsibilities of those particular teams is to essentially focus and assess this data, cleanse it, understand the trends to help us identify forecasts for the future as well. So it's a really great tool for us. We source our data from the key sources such as CoreLogic, which is the largest provider of real estate data in Australia, the ABS, RBA, and other private and public data agencies. We actually spend hundreds of thousands of dollars each year to acquire this particular data. That's the importance that we place on using this, because it's really important to understand how to use that for one, and then how to implement that for our clients in different markets. Because as I mentioned before, we don't have a one size fits all approach. Every client's needs are different. Every client's budget is different. Their yield requirements are different. Their strategies are different. And therefore you can't just pick the same location, put every single client into that particular location. So we have multiple locations that we've used to our data to help identify those particular areas, which is really, really important. And that's data from a macroeconomic point of view. So looking at GDP, income growth, unemployment, inflation, interest rates, infrastructure investment, all the way through to your real estate fundamental data, such as your average land size for a particular suburb, vacancy rates, asking rents, increasing, decreasing, median sales prices, social housing, online search interest, to name a few. So really, really important to understand what that data means, but also important to note that in some instances, there can be too much data, and the risk of analysis paralysis can remove the ability to make smart decisions. So the more variables you look at, the more important variables can dilute in some instances. So that's why we have a team of experts who are sort of understanding what is providing the greatest correlation to support what we're looking for our particular needs, which is really, really important. I have spoken a fair bit about sort of the market conditions and data as well. It's really, really important to also look at the other side of the tray, and that's looking at your real estate fundamentals. To give you a sense of what that looks like, Milk Chocolate places about 70% of the growth influences on location identification, whilst 30% is placed on the asset selection. And asset selection can be anything from these four items that I've noted here. You've got your location, options, the character of the home, and also the quality of that particular home. I won't spend too much time here, but when you're looking at the location, there's a couple of things that we look at. Obviously the orientation of that particular home. So depending on what state and the climate where that property is located, you want to make sure that your home is orientated to maximize as much natural light as possible to keep that home warm. Australians like to live and entertain in those warm, sunny areas. And for instance, if you have a home in a cool area such as Ballarat and it's south facing to the rear where there is no sunlight coming into those living spaces, that home becomes very much undesirable. You also increase your chances of mold, damp, and cold cold issues that are going to provide you really significant long-term maintenance considerations, which is going to affect the asset and your investment on that particular asset as well. And likewise, if you've got a home, in far north Queensland, a north-facing rear is probably going to be too hot for you as well. So there's some of the subtleties that we look at when we're purchasing a home. High side of the street versus low side of the street. Is it flat versus sloped? We see this a lot. Some of our clients come to us with existing properties and they've purchased a home that is on a sloping block. And believe it or not, there's a lot of issues with damp, water ingress. They've had to spend tens of thousands of dollars building retaining walls to stop any of that water running into their particular property. If it's in Queensland, it's generally on piers, water getting in under those piers, rotting, there's movement, there's cracking. And again, significant amounts of money is required to be spent. So simple things as identifying the right asset, such as orientation and flat versus slope, are going to save you significant amounts of money in the future. Is it on a main road versus a thoroughfare road? Obviously pretty simple to understand why you want something that is on a quiet residential street versus a thoroughfare or a main road. They are less desirable, there's more noise, and ultimately the value of that home is going to be slower and increasing in value. And for investment purposes, ideally we want to be within about a 20-minute walk of public transport, shops, local amenities within that particular suburb. That's going to be desirable for your tenant. It's going to help you reduce your vacancy rates in that particular asset, and help you increase the idyllic nature of that home from an investment point of view. Looking at options, this is something we place a significant emphasis on. So a home that has the ability to add options in the future. So Milk Chocolate has an ethos where we prefer to be purchasing established houses that are on significant amounts of land. And when I say significant, I'm talking about above average for that particular location. So we want established houses where there's the ability to add value. And that's irrespective if the client wants to take advantage of that. We'll obviously, if they don't want to do any renovations in that part of their plan, we'll buy a house where they don't have to touch that. However, we want to make sure that still that home has the options in the future, because that's ultimately going to underpin the value of that home based on the amount of options that it provides for any future buyers. So if that house has the ability to put a granny flat on, subdivide, extend, go up, ultimately that's going to attract a larger buying pool of potential buyers in the future, because you're going to attract developers, builders, and homeowners all wanting to take advantage of those particular options based on the house next door that is taking up the full allotment of space on that particular land without any options to add value. There's significant value placed on those options. So it's really important to make sure the house you're buying comes with those options. Character of the home, we place a significant emphasis on this. So we generally will target homes that present with character. Older homes not only retain a lot of their original charm, but they're also generally built to a higher quality standard and tend to perform better from a resale perspective. More attractive to family home buyers who will buy with their heart. They won't buy with their head. They'll fall in love with the curbside appeal of that particular asset. They're bigger boned, they're well apportioned, which is certainly a key driver for better functionality and better living for that particular asset. High ceilings, wide hallways, generous sized bedrooms are all significant influences for homes that come with character. And then finally, guys, just quality. So just simply do your checks, get your building and pest report, get your own independent report. Don't use the agent's report. Electrical safety reports, invasive plumbing inspection, structural engineer checks. These are all the things that we do to safeguard the investment for our particular clients, because a couple of $1,000s spent now can save you tens of thousands of dollars in the future if you don't do these. We see a lot of times that clients want to avoid getting these reports, and we very much make sure that you go down that path, because it is only going to safeguard your funds and your investment in the long term. Really good to understand if you're viewing a property yourself, steps cracking in the brickwork versus vertical lines. What do they mean? One of those means that the house is sloping and there's probably going to be significant maintenance works to re-stump that home. Beware of the home handyman renovation. So do your checks, talk to the agents, understand who's renovated the home, how's it been renovated, what's the quality, because if you can see anything on face value that doesn't look great, imagine what's behind those walls and under the house that you can't see. Stormwater, simply, is that connected to the draining to the subfloor, or is it just dropping into the ground? If it's dropping to the ground next to piers are going to move, the house is going to move. So simple things like that, guys, are really, really important to understand when you're looking at assets and looking at buying property, whether it be your family home or investment as well. So that's enough for me. I'll pass over to Michael to keep on going.
Awesome, mate. Thank you very much for that. So unfortunately, I'm not going to give you such a respite just yet. I'm going to take everyone just through two really quick case studies, one on a family home purchase and one on an investment property purchase. But what I was just going to get Richie to do firstly was at Milk Chocolate, we actually also have a tech team as well, and we're developing a tool to help our clients find family homes and locations for their family homes. Particularly works really well for clients, expat clients that haven't been in Australia for quite some time and are unsure of where they might want to repatriate to and where they might want their family home to be. So we'll just quickly show you this tool, which is being developed at the moment, and then I'll take you through a couple of case studies.
Cool, thank you. So as Michael touched on, this is essentially built. We're launching and piloting our first client on this particular product from next week. In this particular instance, we're just going to talk about a family home purchase. So there's a couple of key things that we always are asked when we're looking to purchase a family home for a client. One, if they're living overseas or living in the same suburb they want to buy, there's a few key fundamentals. One is where do they work? How far do they want to travel each day? What's their form of transport? Are they looking to be near schools? What schools are they? How far away from those schools? Where their family and friends are? How far they want to be away from their family and friends? They're some of the key instances that we look at when we're identifying the right area. Obviously, notwithstanding the client's budget, the property values, the functionality of that particular home, how big it needs to be, etc. We essentially wash all of that information and help our clients understand what is the best location to be buying that family home. So we use a machine learning tool called Bryce. Bryce essentially will understand your key inputs and pinpoint the perfect location based on the property requirements, but also your location requirements. The product will take you through a score for those particular suburbs. So it'll rank those suburbs from highest to lowest. And that score is a subjective score based on your particular subjective inputs and requirements. So it's not a market score as such, but you can see here, you can click on there and it would take you to a market score for that particular suburb. But the lifestyle summary is talking to the subjective results based on your key requirements. As you work through the process, once we identify the right area to buy that home in, once you've reviewed and researched and you're comfortable with those recommendations, we move through what we call the search tracker. This is a real-time transparent tool where you'll be able to understand all the properties that we've looked at, what we've picked, what we've shortlisted, any active listings and what's been rejected. This is a direct API coming from CoreLogic. So those listings are coming through to us in real time. We're reviewing them in real time and identifying what we like, what we don't like, what we're expecting. And as we work through that process, as we're inspecting properties, you start to see our feedback feed through. So why we like it, giving you the opportunity to say, no way, don't like it, or yes, please continue, understanding the photos, our initial appraisal, the SWOT analysis, chance of buying, what the vendor terms are, any recommendations, all the way through to preparing yourself to purchase that home, whether it be at auction or private treaty. The details required throughout that particular process. So, you need to sign a contract, you pay your deposit, unconditional exchange, all those really key touch points where it is a really manual, paper heavy process. We're digitizing that whole journey to make it as simple as possible for you. So this is just really a quick highlight of the tool that we're building and only a small component of it, but it's important to take you guys through that today.
Awesome, thank you. And so next, guys, I actually just wanted to share our family home brief. That was a really lovely brief. So a similar brief of many expats is our clients wanted to purchase a home that when the time was right that they could move back into, but needed to serve as a home that would rent well until they decided to come back to Australia, but also a home that would serve well as an investment property as well, because it might not be the forever home, so a home that that would still get capital growth in the future. And what we did with these particular clients is, again, like many expats, they're a little unsure exactly, what region of Melbourne that they wanted to live in. We're considering some regional areas such as Geelong, and then also the Bayside suburbs as well. And then we also talked about the inner west areas for a little while as well. So our data and real estate team presented back, various research on, the different areas on block sizes, asset types, and so forth. Where we saw sort of future capital growth for those particular areas, rental yields, and so on. And ultimately, we ended on the Bayside suburbs. Our clients had a very similar sort of purchasing ethos to us, where they were looking for a really character-filled home, which is what we really love to look for, particularly in investment properties and family homes as well. And ultimately, we ended up purchasing this great property, really filled with character in a fantastic location that has, performed really well to date. And so we're seeing sort of capital growth in that property. Our team appraised this property just at the end of last year, and it has been performing really well. But all of the characteristics characteristics and the hallmarks we look for in a property, particularly in Melbourne. It has north-facing living zones, really character-filled, and does, although absolutely, sort of ready to live in, does come with the options to do some further work down the track as well. So just a nice project to share. Lots of expats are sort of going through, not quite sure exactly what areas they want to live in. Needs to be a home that would rent well until they move back in, and then, also a home that will still work well as an investment so that they can either draw on the equity to buy, that sort of forever family home down the track, or sell the home as well. So just a nice example to share there. Then secondly, just wanted to share an investment property. So this was for another client where we were looking to start to build out a property portfolio for them, and what we call a buy, renovate and hold. So essentially, our clients came to us. It was a pure investment property, and we actually purchased this home back in 2000. So basically, we purchased the home in Brisbane. So much like the rest of Queensland, we were seeing this particular area in Brisbane, in the northern suburbs of Brisbane, seeing, sort of huge upswings in the property market as lots of people were moving to the Sunshine State to take advantage of the enviable lifestyle and the rapidly improving infrastructure due to the Olympics. And the relatively low property prices when we purchased this home. So it really was causing that market to thrive. So our clients came to us and didn't have weren't bedded down to a particular area. They were happy to take our recommendations, looking at a macro view of the Australian marketplace. We worked with them on a sort of macro lens of the Australian marketplace, and ultimately recommended Brisbane and this particular suburb in Brisbane that we ended up purchasing in. So we purchased this home in October 2020. We actually purchased it for $471,700, which sounds, which sounds a little impossible to do now, but for a really great price. And on settlement, the property was rented while we undertook the planning and approval for a structural renovation. So what we did was we added an additional bedroom with a walk-in robe and an ensuite. And so we also gave the existing property a bit of a refresh. So the work cost just on $110,000. And since those works have been done, and most recently, we have had the home reappraised at $885,000, which is, a really fantastic uptick. So the value's increased by 87.62% or 42.71% per annum. And the property is currently renting for $600 a week, which is a gross yield of 3.38%. The long-term trend in this actual area is 6.8%. So although that we, have managed equity via renovation, still, outperforming the long-term trend. And what we mean by that is, you can buy two houses in the same suburb, but it's about finding a home that comes with those options, and it comes with the distinguishing features that Richie mentioned that match the real estate fundamentals that are ultimately going to help it outperform those suburb averages. So this home actually comes with the ability to do a couple of things. So obviously our clients have taken advantage of the option of adding additional floor space, so a bedroom and an ensuite. But there also is the ability to actually knock this home down and build a duplex, so 3 townhouses or potentially even 4 apartments, still subject to council approval. Not saying that our client would do that, but it does, come with those options down the track if they ever, wanted to do that. And just briefly looking at the floor plan there, I mean, as you can see, it was a fairly simple extension, but it was just a really effective extension. So we kept the services in their existing areas, put a hallway essentially between the 2 bedrooms, which allowed us to open up a space for the master bedroom, for the ensuite and the walk-in wardrobe, and it made the plumbing to that ensuite, nice and easy, as it was just coming straight from the back of the house there. So just a really good example of just, a very smart basic renovation, but has really performed well from a return on investment perspective from cap growth and rental yield. So that was just a couple of quick case studies that we wanted to share there. And just again, guys, just on our services, we hope that we've shared some things today that would give you the tools to aiding your next property purchase, whether that be a family home or investment property. But if you prefer not to go it alone, we are certainly here to help. So looking at that planning, whether it be again planning, to purchase a family home and what areas you should be looking at because you might not have lived in Australia for a long time, or where would be a good place to buy an investment property, through to purchasing, construction and building if needed, and also to property management thereafter as well. So really that end-to-end of the property journey for you. And just you know, why sort of the benefits of using milk chocolate. So essentially, you know, if we look at our business versus a regular buyer's agent, or essentially doing it on your own from afar, we do have you know, experts in negotiation. All of our buyer's agents, direct real estate agents, and really understand how to negotiate. That location and asset selection expertise, access to expert referral partners, and you know, specialist expat referral partners. A non-commission based business, so everyone in our business earns a salary. They don't get paid any commission, so they're only recommending homes because they really believe they are the best homes for our clients. We have a team of economists, property economists, licensed valuers, and so forth, internal builders and property managers. So really a service that just has everyone there for you. So essentially, guys, that was just you know, a bit about milk chocolate. And again, I know Richie's mentioned this, but just the platform that we're building as well is just going to touch on again.
Yeah. So as we've touched on, the platform that we're building will give you the ability to essentially onboard and register with milk chocolate, provide us your insight, so the ability to either to want to come to buy one property, build a portfolio, buy a family home, renovate an existing home, or have a property that you currently own put through under property management services. You'll be able to then work with us via the platform to determine the best strategy for you. So we'll create what we call a game plan. So a game plan will take into account your key inputs. So how much funds you have available, what is your monthly maximum holding costs, and what is your end goals, and what is that time frame to achieve those particular goals. We'll provide you with scenarios using property and the strategies within property to achieve those particular goals, showing you everything from something that is quite conservative through to something that's a little bit more adventurous, where it includes more renovations, developments, for instance. You'll be able to compare those, understand all of the financials, all of the modeling assumptions, etc. Once you're comfortable with that, there is back and forth, etc. Then you can proceed through to commencing that first particular purchase, where I showed you on those previous screens, where you see the locations that we've identified for that particular purchase, all the information, the reasons why we're recommending those areas, into the search, into the purchase, exchange, settlement. And then thereafter, you have the ability to have your property managed on the platform where it's an active portfolio. So you'll be able to see real-time valuations, debt position, any recommendations, the details around your tenant, your maintenance requirements, etc. So essentially, it's your property, I don't like to say this, the one-stop shop, where everything is managed on the platform under the one roof. So it's really, really simple to use. We're really excited to be launching that in the next couple of weeks.
Awesome. Thank you. Yeah, thank you very much. Well, again, guys, thanks so much for your time. That concludes our webinar for today. Really do thank everyone. We know everyone's busy, so appreciate you taking your lunch breaks to listen to us and to Odin Mortgage as well. We hope you got something out of today, and what we'll also do is we'll share the Sabrina will share the recording, but also a Calendly link as well, so you can book in a no obligation call if you'd like to discuss anything to do with planning, you know, purchasing a family home and investment property, building, or property management. So you can have a call to speak directly with one of our subject matter experts. And from us personally, if you'd like to follow us for sort of regular case studies and updates, you can follow us on Instagram at milkchoc_property. So you can find us on Instagram, and we're posting regularly there. But thank you very much again. And I think we might have a couple of questions.
We do have a couple of questions. So before I let you guys whip off, I'm not sure if you can read those, but I'll read them out for everybody. Not directed at anybody in particular. So I think maybe the first one came up through your slides there, Richie. The first one says, if the data shows we've passed the bottom of the market now, what effect do you anticipate the fixed rate cliff and current global banking sector instability will have? Is it possible we're in a temporary upswing?
Yeah, I can answer that. So with regards to the fixed rate cliff, and I know Ben obviously spoke about that in detail, from reports and research and attending webinars with the CBA chief economist, their initial feedback is that the effect to date on the increased interest rates has been stable, noting the fact that there is not obviously the fixed rate cliff, but noting that mortgage holders are paying more now than they have ever based on those more infant stage mortgages. He said what we would have generally seen previously is more of those those mortgagees going into default a little bit earlier, but he said it feels quite stable at this particular stage. I can't really, it's hard to answer that particular question without sort of, fully understanding all of the data for that particular point. But what we can say is that you would think that people noting that their fixed rates are going to be changing to variable within months or a couple of months, that they're going to be working with their mortgage brokers, their financial advisors, their team around them to make sure that they can safeguard their assets and make sure that they've got the ability to hold that particular asset through that period of time. Because if you suddenly realize that your interest rate goes from 1.5% to 5.5% overnight and you didn't realize that, then yes, that's unfortunately, that's not great, but you should be well aware that that's going to be changing, and we should be seeing signs of it now, that people, if they aren't going to be able to afford to hold that asset, when it does go to variable, then they should be starting to sell those assets now. But from our feedback and on what we're seeing on the ground, we're not seeing many sales by default at this particular stage. So I suppose that's the best way I could probably answer that.
Thanks, Richie. I think just an addition to that question, adding further, the recession in the US is almost certain by the end of this year. How will it affect the property prices when the chain of events, such as unemployment rate, would also creep up in Australia? Anybody?
Yeah, it's like the Australian property market is always cyclical, right? So we are always expecting the market to increase and decrease in value, and different markets react differently as well to global events. What we do know historically is that significant global events in some cases haven't really affected the Australian property market as it has affected other markets. So it's one, all we can do at this particular point in time. We still recommend absolutely buying when you have the ability to buy a property, if that is part of your overall strategy. And the intention should always be to hold it long term. So if there is going to be a potential downswing, if you are holding it for at least 10 years time, you are absolutely going to see the greater gains over that period of time. But if you were to hold and sell it within a year and a half, then it's probably not going to be the greatest investment. So that would be the recommendation in that particular question.
Thanks, Richie. I think we're almost at the end. I have had a request for the PowerPoint deck, so I'll speak to you guys about what you want to share there, but definitely the recording will be shared with everyone who attended today and registered. I think that's it. If anybody wants to throw another question out there, now's the time to do it. Otherwise, I think we're going to wrap up. Okay. All right. So Ben,
I'll just add one thing.
Yes, you may.
I'll add one thing on the fixed rate cliff. On that, just the majority of homeowners are still on variable rates. They're on variable rates, the majority are. So they have been on the 5-6% interest rates for the past few months now. And there was a chart showing the default rates, or how many homeowners were late on their payments by 90 days. And that trend has actually been on a decline, showing that people have been managing to budget effectively. So I think with that in mind, it seems like when they were discussing the fixed rate cliff, it wasn't as huge as a risk as initially thought, just because the majority of people were able to still manage their budget and they were already on the higher rate. So it really will just be about the people who have no clue that their fixed rate's about to end, but they will shortly, I suppose, when the money starts to deplete there.
I suppose also just to add to that, Ben, when they're getting approval for that fixed rate at 1.5%, if that's when the mortgage was originated, they had the 3% serviceability buffer on that, which would have mean they were serviced at 4.5% in that particular instance. So the rates are, yes, they're higher than 4.5%, but 1.3% or thereabouts, greater than the max serviceability at that point in time, which in most instances, you wouldn't think that would be too much of a concern.
Yeah, all it does is just reduce your borrowing power, from what I can see. So whereas you could borrow, 2 million before, 1.5, and now you can only borrow 1.2 now, something like that.
Yeah.
But it shouldn't go from you borrowing 1 million to negative, like you're actually unable to afford. In most instances, there's a lot of conservative measures already applied from the banks in terms of buffers and discounting on your income and buffers on the expenses. Yeah. So generally it's okay. If anything, we want things to be more lenient. So maybe sometime next year, we may have a lending product that replicates Kudos Bank, the one that has exited, or even better, for those of you who are living in the Middle East, because you definitely want a bank that understands the 0% income tax rate. It really hurts when, a lender applies Australian income tax onto that, and we're looking at less than half of your income. It just doesn't make any sense. So yeah, all good.
We got one more question. What tips do you have for us expats to be able to keep finance going without hitting the finance ceiling and the banks saying no more?
To be able to keep finance going, I'm assuming to be able to keep borrowing more money without hitting the borrowing capacity cap. Keep really with income, with borrowing power, it's quite a simple calculation when you think about it. It's just income minus expenses equals how much you have available for a mortgage. So with income, you want to either earn more, get a pay rise, jump jobs, or include a co-borrower. One of the things that we can see improving your borrowing power a lot is sometimes our clients just apply in their own name. Just maybe add your spouse on. Even if your spouse is not an Australian citizen, some people think, okay, I don't want to add my spouse because she's not an Australian citizen. There's going to be additional stamp duty surcharge because she's a foreigner. It's okay. What we can do is we can add your foreigner spouse on as a co-borrower, but he or she does not need to be on the property title. So there won't be any stamp duty implications, but we will still use their income as a co-borrower. That's actually acceptable. So yeah, any ways to increase income will be great. And then any ways to decrease expenses will be great. We had some instances where clients, they were renting at quite an expensive place and they had relatives or family, and they just moved in. They boarded with, boarding with their family and relatives. Essentially, the rental expense went from something quite high to $0. That would increase your borrowing quite significantly. Some clients are only doing this just temporarily to max out their borrowing, and then potentially they move and start renting again. But for those clients, then yeah, you just got to make sure that you'll be able to afford your mortgage at that point, because the lender gave you that lending because you were boarding indefinitely at that point. Yeah.
Ben, sorry, somebody's asked if you can repeat the name of the banks friendly for expats, but I think you only named the ones that have pulled out recently. Am I correct?
Well, I don't think I mentioned any banks that were lenient. Okay, so I did mention CBA being one of the banks that lend up to 90% with lenders mortgage insurance, but CBA is actually one of the harshest banks in terms of that. They'll do the 20% discounting. They'll apply Australian income tax rates, but they're flexible in other areas. In terms of banks that will let you use 0% income tax rates, we've got Heritage Bank, which is great. Bank of Western Australia, St. George Bank. These would be the banks that I'd be looking at in terms of 0% income tax rates. But every bank has their own annoying credit policies. Okay, so like St. George Bank, maximum 70% loan to value ratio, and they won't do refinances. Only purchases, and then there's ways around that as well. And then Heritage, they have their retirement age policy. I said no retirement age policy, but they're the only banks that apply a retirement age policy. So if you're 50, then they only lend to you for something like 15, 17 years. And then Bank of Western Australia, maximum loan to value ratio is 60%. So there are other ways we can do 80% with. Yeah, so it's not so clear cut. Like, let's say if you're living in Australia as an Australian resident, everything's so simple. Everyone earns Australian dollar. And all the banks will treat you the same. Australian dollar, they're going to take 100% of it, and they're going to apply Australian income tax rate. That's because that's everybody. And all 40, 50 banks will lend to you the same. If one bank lends to you 700,000, the other bank will lend to you 750. But the variance is very, very small. Whereas I showed you the variance for foreign income is up to 500% in terms of difference. So that's where it pays to really understand the credit policies of these banks and be at the forefront of it, because I wouldn't say month on month they're changing the credit policies, but maybe on a quarterly basis where we're seeing credit policies change, in certain areas of your income, some, in terms of bonuses or allowances or basic salary and so forth.
Amazing. Thank you, Ben. I don't think we've got any more questions, so I think we might wrap up if you guys don't have any more comments. I want to say a massive thank you on behalf of the Australian Business Council to Ben from Odin and Michael and Richie from Milk Chocolate. Thanks to everyone who turned up. We had a nice little crowd in the end. So we'll be sending out the recording and then potentially some of the slides. I'll speak to you guys about that. Right.
No worries.
Awesome.
All right. Thanks a lot.
Thanks, guys.
Thanks,
for your
guys.
time.
Bye.
See ya.
Bye.
Bye.
See ya.